What's up, YouTube? It's the boy OMG Pips, and today I'm bringing you guys a video on the top 2 ICT trading models. You don't need to be a pro, you don't need to be a seasoned trader to trade these setups. All you need to know is the ICT PD array matrix. Without yapping too much, the first trading model is based on order blocks. You don't need bias, you just need to understand what order blocks are, and in this video I'm going to be showing you how to trade them. Alright? Description: order blocks are areas on the chart where large institutional orders have been placed. This often leads to significant price moves. These zones act as strong support or resistance levels, providing high probability entry points for traders. Meaning, order blocks act as strong support or resistance. Every new trader is taught about support and resistance. Now, I want you to use that same concept of support and resistance and apply it instead to order blocks. Instead of applying it to highs and lows, you apply it to order blocks. How it works: the first step in utilizing this trading strategy is to identify significant price moves. Look for areas on the chart where price has moved sharply, indicating institutional activity, meaning the highs and the lows. As marked right here, we can see we have a low here, we have the high, we have the low, we have the high, we have the low. This is the first step: identifying significant price moves. Identify the significant swings, right? During this stage, the second stage or the second step, order block zones, typically found at the origin of the significant move. Example: the last bearish candle before an uptrend, or the last bullish candle before a downtrend. Can you see this? The last bearish candle, this candle, before an uptrend. The last bearish candle, this candle right here, before an uptrend. The last bearish candle before an uptrend. And on the other side, we have the last bullish candle right here before a downtrend. The last bullish candle, which is this large bullish candle right here, before a downtrend. These are our order block zones, as we have marked them in this green highlight right here. After we mark our levels, we go to the third step: wait for retracement. Wait for price to retrace back to the order block zones. These zones that we have marked, wait for price to retrace back to these zones. So in this example, we can see we have this order block right here. Price showed up and then came back down into this order block zone, and then it showed up again. And we can see right here it started coming down, but in this scenario it did not arrive in this order block. It reversed from this fair value gap, but we don't care about the fair value gap right now because this model is the order block model. So we disregard this fair value gap. So price created this order block and started shooting up, but before taking out the buy side liquidity right here, it crashed again, coming back down into the order block level. This order block right here is the same order block right here, just magnified. This order block is this order block, right? Wait for retracement, wait for price to retrace back into the order block zone. Price went up and now it has retraced back into the order block zone. After price retraces back into our order block, we go to the fourth step, and the fourth step is the confirmation. Look for additional confirmation signals to validate the entry. The order block forms on a higher time frame, and we look for the confirmation on a lower time frame. So if this was a 4-hour time frame, this would be the 15-minute time frame. Once price retraces back into the order block zone, we look for confirmation of a bullish momentum. We look for it to break structure to the upside, right? So this is the 15-minute time frame right here. Price has retraced back into the order block zone. Now we look for it to break structure right here, and look for a PDRA in here that we're going to go long on. Look for a PDRA in here that we're going to buy on. So look for confirmation, and this price action right here, as you can see, is the same price action that's here. It's just a little bit magnified. This price action right here is the same price action that is right here. So in this case, you can see after price tapped into that order block zone, we wait for a break of market structure, or a break of structure, or a market structure shift. And we can see we got that market structure shift right here. Price mitigated the order block zone, and then now it has broken structure right here to the upside. And after it broke structure to the upside, it left the fair value gap behind, and that fair value gap is what we are going to use as our entry. Do you see how everything lines up together? First things first, we mark the order blocks, or we identify the swing levels, mark the order block zones, wait for price to retrace to the order block. Once price mitigates the order block, we drop down to the lower time frame and wait for confirmation. The confirmation is right here. Price breaks structure to the upside, leaves the fair value gap behind. We use that fair value gap as our entry. Or if there was no fair value gap right here, we would use this order block right here as our entry. So price would break structure to the upside, and we would have our entry on this order block. But we have a fair value gap right here, and this fair value gap is most likely to act as a support for price going to the upside. So once we have our entry, once we have our buy limit or buy stop, or I don't know, this is what it looks like on the lower time frame. So this is the 4-hour time frame right here. This is the 4-hour time frame right here, and this is the 15-minute time frame right here. Our order block zones as marked on the 4-hour time frame, this is how they look on the 15-minute time frame. And we have our entry right there, the same entry that we have right here. This entry is the same entry that we have right here. So price came back into this order block. We got our confirmation on the 15-minute time frame, put our entry on the fair value gap, and now we target this high because it is the high that created this order block. We target that high, and yeah, you can see right here on the 15-minute time frame, still we broke structure, fair value gap right there. That's where we have our entry. Price broke to the upside, came back down into the fair value gap, and then now it has started shooting to the upside. Easy, right? Boom, there we have it. TP smashed, entry right there. As you can see, it's very easy, very simple, very straightforward. It's not too complicated. You don't have to have a lot of things on your charts. You just have to identify the order blocks and wait for the confirmation. Identify the order blocks, or identify the swing levels, mark the order blocks, wait for retracement to the order block. Right there, you can see we took out that buy side liquidity. Wait for retracement to the order block, and then wait for a confirmation, and you'll be set. Order block, order block, order block, retracement into the order block, confirmation on the downs on the lower time frame. We secure profit, we secure funds, we secure our payout just as easily as that. So that is the first trading model, the order block model. So I hope you enjoyed that, and if you did, if you learned something, make sure to hit that subscribe button, make sure to hit that like button, and leave a comment down below if you haven't understood anything. I'll be glad to help you. The second model, the second trading model, the second ICT model. This model is based on liquidity pools. This basically means buy side liquidity or sell side liquidity. Relative equal highs, relative equal lows, single highs, single lows. Description: liquidity pools are areas where stop loss orders and limit orders are concentrated, often leading to price movements towards these zones. Identifying these areas helps traders anticipate where price might go to capture liquidity before reversing. So from the description, I'm going to show you how it works. Step number 1, identify liquidity zones. Look for areas where stop loss orders are likely placed, such as above previous highs for sell stops or below previous lows for buy stops. So this is what it looks like. This is just a naked chart right here, and we're going to identify our liquid zones, our liquidity zones. And that is what we have done right here. These levels represent liquidity, swing levels. So price came down, created this swing low and went up. We marked that as our swing low. It went up, created that high, came back down. We marked that as our swing high. Went up, took out this swing high right here, created that swing high right there. Once we took out this liquidity right here, price came down, created these relative equal lows, so we have liquidity down there. Went up, created buy side liquidity, buy side liquidity, sell side liquidity, buy side liquidity, sell side liquidity, sell side liquidity right here. So these are just liquidity levels, and that is the first step. We look for areas where stop loss orders are likely to be placed. Once we mark our levels, we go to the second step. Once we have marked our levels, we go to the second step, which is to wait for price movement. Monitor price as it approaches these liquidity zones. Monitor price as it approaches the liquidity zones we have marked. Price was right here. We have buy side liquidity right there, and right here we can see it took out that liquidity right there, right? So what you would do here is go on the lower time frame. So let's say this is the 4-hour time frame. You would go down to the 15-minute time frame and wait for and look for OTE entry in here, or look for a break of structure to the downside and enter on a fair value gap or an order block to the downside, targeting sell side liquidity. But I'm going to show you exactly how to execute that in a bit. Just stay with me, right? So wait for price movement, monitor price as it approaches these liquidity zones. Step number 3, capture liquidity. Anticipate price capturing liquidity and potentially reversing after doing so. So that is what happened right here. We captured buy side liquidity and price reversed significantly to the downside. And since we have sell side liquidity right here and we have sell side liquidity right here, we're going to anticipate price capturing liquidity below this sell side liquidity or below this sell side liquidity and reversing to the upside, because that is what it says right here. Anticipate price capturing liquidity and potentially reversing after doing so. So we don't care about this move because it has already happened, right? We don't care about it because it has already happened. Now we are interested in these levels. We can see price took out this sell side liquidity right here, created this bullish candle as if it was going higher, but it failed. On this candle went down, on this candle it went down, and eventually it took out this sell side liquidity right here. And if you can look closely below this sell side liquidity, we have this order block. We have this order block right here, and we have this order block right here. We have this inversion fair value gap, but we don't really care about that. We're just looking at the liquidity. So this order block below this sell side liquidity acts as a strong support because we have two strong PD arrays in one area, and this is going to act as a strong support. So once we take out the sell side liquidity, price mitigates the order block as well in there. You can see it marked even more clear right here. Price took out this buy side liquidity, dropped to the downside, took out that sell side liquidity, took out this sell side liquidity right here as well, mitigated that order block. And on the next slide, we drop down to the lower time frame. You can see still the same price action, and right here it's a little bit more clearer. The order block on the 4-hour time frame, this order block right here, this order block on the 4-hour time frame is looking like that on the 15-minute time frame, right, on the lower time frame. So this is what the price action looks like on the lower time frame. And once we take out the sell side liquidity right here, we mitigate the 4-hour order block right there. We just have to wait for a confirmation in this area. Wait for price to take out liquidity, then wait for a confirmation. Step number 4, confirmation. Look for reversal signals around these zones to enter trades. So this move right here is the same move that you see right here, just a little bit magnified. That is that move right here. So we look for confirmation around this area right here, and once price takes out the liquidity right here, you can see it right here. As it develops, as it starts going higher, you can see it leaves a fair value gap behind, right? And once it leaves the fair value gap behind, that is the fair value gap that we use as our entry. Put our entry right there above the fair value gap and put our stop below this low. I don't know why I didn't put it below the low, but ideally you would have your low, ideally you'd have your stop loss below the low in that zone. So we put our buy limit right there. Once we get the confirmation in the form of this fair value gap, we put our buy limit right there, and we can see this is what it looks like on the higher time frame. On the lower time frame we have this, on the higher time frame we have this, right? So side liquidity, order block, and then price starts shooting higher. But on the lower time frame we have our fair value gap in there, and that is where we have our entry. Easy. Once price starts pushing higher, it eventually crashes back into the fair value gap on the lower time frame. You can see it has triggered our entry. We have our entry right there. You can see same entry right here. Once price triggers our entry, we just have to wait and see what happens. TP, we have our TP on the previous high, the buy side liquidity. We can see price triggered our entry right there, and boom, shot higher, hit our TP, takes out the buy side liquidity, and yeah man, it's as easy as that. It's as simple as that. On the lower time frame, this is what it looks like. You can see we had our fair value gap right there. Price came back down into our fair value gap, triggered it, and showed up aggressively, taking out our TP on the buy side liquidity. step number 1, identify the liquidity zones. We mark our levels. Step number 2, monitor price as it approaches the levels. Step number 3, capture liquidity. Wait for price to capture liquidity. Step number 4, look for confirmation. Right?